Thank you for the welcome, Hardik, and your kind words, Anil Bhai. I would like to thank BCS who has allowed me this opportunity to present the. It is I consider this as one of the milestone lectures which BCS does, especially for young chartered accountants and especially for articles who have just begun their journey with ITRs. And also this is one particular thing which, when I went through all these forms and returns while preparing my PPT, I saw how many minute changes keep coming every year, which, unless and until you go through yourself, you might miss. So a lecture like this could really, help the whole community with this. I would just like to start with a small fun fact about how ITRs have moved in the last 2 years. So 2 years ago, the ITR 2 used to have around ITR 2 used to have around 25 pages, which has today increased to 35 pages. Just in 2 years, they have increased 10 pages in your normal PDF. And as for ITR 3, it has moved from 45 pages to 61 pages. So one can only imagine how many changes come year on year and how much one has to be aware of what should not be missed and what should be taken care of. With this, I would like to begin my presentation and take you through the slides that I have prepared. So first, we'll begin with the applicability of who is supposed to file an ITR. I'll just briefly run through these points. So Section 139 refers to every person who is supposed to file an ITR. 139(1)(a) refers to every company and firm that has to file an ITR return. Firm includes an LLP. Coming to 139(1)(b), it refers to every person not included above, that is not being a company and firm, who has to file a return. Now, with this, it gets slightly complicated once your provisos start. So the first proviso also gives certain. So before that, in your clause B, it says every person not being included in A above. So any person who is not a company or firm will get a basic minimum limit, beyond which, once you cross that, you have to file your return. So any person who does not fall in this clause but is staying in a particular area that is specified by the CBDT and is also earning or also spending more than 50,000 towards electricity, or any one of the following, being that is staying in a house which is bigger than what CBTT has notified. I'll come back to that notification. Or has a car, whether owned or on lease, or is spending on foreign travel, or holds a credit card, or is a member of a club. Now, in this case, the CBDT has notified areas for which these very specific conditions apply. So those areas would be where there's a municipality, or there's a cantonment board, or is basically an urban area, and where the specified floor area is considered. CBDT has, in a circular in 2001, mentioned 2000 square feet as the specified floor area. So if you complete any one of these conditions, and at the same time you are not supposed to file, considering that your basic exemption limit is not crossed, then in that case you will have to file a return. Then coming to proviso 7, again, seventh proviso, again, if you are under the basic exemption limit and you have deposited 1 crore in your current account, or you have incurred at least 2 lakhs on foreign travel, or you have incurred expenditure of 1 lakh or more towards electricity during the year. So in this case, you will have to file a return whether or not you are breaching your basic exemption limit. When talking about foreign travel, the CBDT has notified that any pilgrimage to Hajj in Saudi Arabia or to Kailash Mansarovar in China will be excluded and not considered for foreign travel. At the same time, Rule 12AB also puts on certain more conditions, wherein if you fulfill these, then you have to file your returns again. So if you are a business and you have a turnover of more than 60 lakhs, if you are in a profession, then gross receipts more than 10 lakhs, where you have TDS or TCS combined deducted for you for 20, more than 25,000, and where you have deposited around 50, more than 50 lakhs in your savings account. In this case, in all these cases, even if you fall below your basic exemption limit, you would have to file your income tax return. So these are certain cases which one needs to analyze and ensure that you are not fulfilling when you are not filing your income tax return. Coming to the next one, where you have where the assessee has a signing power in any account which is located outside India. In that case, again, for such foreign assets, the person who holds the signing power will have to file the return. Where so then coming on to the other portions, so section 139 has 4A, 4B, 4C, and 4D, and more 4E, etc. So those subsections talk about trusts, charitable and religious institutions, political parties, where the CEO of the political party will have to file the return. Then various other venture capital companies, your research associations, business trusts, etc., will have to file the returns. Any person who has incurred a loss will also have to file a return where the person is looking to carry forward such loss. So, having said that, we have covered every person who is required to file an income tax return. Now, such a person will ask the next question: which ITR form am I supposed to file? So, coming to the ITR forms, we have ITR 1, 2, 3, 4, 5, 6, and 7, where resident individuals will be filing ITR 1 if they have income from salary, if they have only one house property, and have income from other sources, where the total income is not more than 50 lakhs. Where the resident individual or an HUF have more than one house property, and specifically they have capital gains income, then you have to come to ITR 2. Further, where you have business profession income, then you have to come to ITR 3, that is specifically for individuals and HUF, where the individual or the HUF and a firm, not being an LLP, when these persons are taking or claiming the benefits of presumptive taxation under 44 AD, ADA, or AE, then they can take ITR 4. So ITR 1 and ITR 4 are specifically created as simple forms. They are not very detailed, and normally, if I should mention in number of pages terms, they are not more than, for ITR 1, not more than 4 pages, and for ITR 4, not more than 7 pages. So these are easy forms. However, if you have capital gains income, then you cannot file either of these. Coming to ITR 5, if you are if you're not an individual, HUF, or a company, or a person who is required to file ITR 7, then you are required to file ITR 5. So coming to ITR 6, every company who is not filing under section 11, which would ideally take you to ITR 7, is supposed to file ITR 6. And for ITR 7, every person, including companies, they have to file ITR 7 where they are taking the benefit, or rather they fall under 139 4A, 4B, 4C, or 4D, which, as I mentioned above, would be covered from serial number 4 to serial number 7 over here mentioned in this slide, being trust, charitable or religious institutions, political parties, educational institutions, etc. Now, moving on to changes in the ITR forms as compared to the previous years. AY 24-25 does have a certain amount of changes, which are mainly emanating from the amendments which came in the last full budget, as well as certain small portions where the income tax department felt that the disclosures would give a better clarity in the income of the assessee. So the first change is with respect to your tax audit. Normally, when a tax audit is filed, a chartered accountant will upload it through his authorized CA portal or login. Then the assessee is supposed to accept the tax audit return, which is tax audit form, which has been filed. Now, in this case, at the time of acceptance, earlier only digital signature was allowed, but now a welcome step has been taken where even an electronic verification code is allowed, which can be normally generated through your net banking, so that not everybody who is otherwise not required to get a digital signature has to take one. So, for example, if you are a partner in a partnership firm, which is otherwise not required under the Companies Act to get a DSC, then in that case, you will be able to get away with take the requirement of a DSC. The next one is a very important one, especially since this affects a lot of individuals. Between the new tax regime and the old tax regime, the new tax regime now has become a default taxation scheme for individuals, HUFs, AOPs, BOIs, etc. So in this case, if you go ahead and file your return, it will automatically pick up the new tax regime. Whereas if you want the benefit of old of the old tax regime, in that case, you will have to specifically opt for it. In this case, where a person is filing ITR 1 or 2, in that case, the option can be taken at the time of filing itself. You need not file any separate form. Whereas a person filing ITR 3, 4, or 5 will require filing of Form 10 IEA before you file your return. Rather, it says by the due date of filing your return, but then it cannot be that you have filed your return first and then you go to file this. Ideally, you should file this form first and then file your income tax return. This is a screenshot of what appears in your income tax return at the time where this particular question has been asked. So it refers to 115 BAC 6, which talks about opting out of the new tax regime. It clearly mentions over here that the new tax regime is the default tax regime. Moving on to the next one, furnishing of due date for filing of return. This is a new line item which otherwise was not available earlier. What this does is this asks you to tell the income tax department what is the due date of filing of return of income according to you for the category of assessee that you are. Now, it could be that you are filing ITR 3 and you do not have tax audit applicable. Then you file it on 31st July. You have tax audit applicable. You file it on 31st October. You have transfer pricing applicable. You file it on 30th November. So in this case, one same income tax return, yet you have three different due dates. Or take ITR 6 for that matter, then 31st October or 31st November would be the two dates. In this case, by specifically mentioning, you are taking away, you are telling income tax explicitly. Now, earlier it used to be implicit based on the tax audit report or transfer pricing report filed. Next one is a smaller change, but it is linked to UDIN. Now, whenever whenever a chartered accountant is required to provide a audit report for your income tax purposes, amongst other things, that time they have to provide a unique document identification number. Now, there were two ways of doing this. The first one being mentioning it within your tax audit report. And second one is after completion of tax audit, separately generating it and mentioning it on the tax audit report. What was noticed is in the second option, certain people were leaving out creation of UDINs. So in that case, now what the income tax department has done by bringing in this change is that they want you to mention the UDIN in your income tax return. So this ensures that before you file your income tax return, the UDIN is generated by the chartered accountant and such a lapse is avoided. Next one brings me to the amendment which was brought in the last budget, where the threshold limits for presumptive taxation were increased. However, while increasing these uh, limits, it was mentioned that these increased limits will only be applicable if the cash receipts were limited to 5% of the total turnover or gross receipts. Therefore, if you are receiving your receipts in cash, in that case you will have to mention it over here in uh, over here. If you can see the mouse pointer, IB, or IB over here in the below screen grabs as well. So what this does is this allows the income tax return to calculate the percentage of cash received. So over here they ask you in A how much you have received in your bank, B is how much you have received by cash, and C is any other mode, so in kind. In that case, if your receipts in cash exceeds 5%, then your limits will be reverted to the old limits. If it is less than 5%, then you will get the benefit of the higher limits. That is 3 crores for 44 AD and 75 lakhs for 44 ADA. The next one is a much talked about amendment which came last year, specifically with MSMEs. So 43B is a payment-based disallowance. If you do not make a particular payment which is mentioned in 43B, then you will not get it in that year. You will get it only in the year of payment. Therefore, 43B has a new clause, clause H, which talks about any payment to an MSME. MSME Act in its section 15 already has specified a limit beyond which if you pay, then the MSME is allowed for certain benefits like interest, etc. So in this case, if you are going beyond the time limit mentioned under section 15 of MSME Act, then the assessee is not allowed the deduction of such amount which is payable to the MSME. In that case, a specific line item has been included under the 43B portion of the ITR, which requires you firstly to disallow the amount. And once you have actually made the payment of the said amount, then you are allowed it in the next year or in the year of payment. 43B otherwise allows a particular benefit, say being if you make the payment for the current year, rather for the previous year, till your due date of filing the return, then you are allowed to take it in the previous year and 43B disallowance is not attracted. However, the same is not allowed for 43BH, which means that even if your delayed payment was made by the time you have filed your return, the same will not be allowed in this previous year, and you will have to take it in the previous year when you have actually made the payment. Coming to the next one, this is an additional disclosure item which has come in for capital gains account scheme, where the government or rather income tax is now asking you to mention the date of deposit, the account number in which you have made such deposit, and the IFS code of the particular bank in which such account is held. All of us these days have come across Dream 11 and other online games. The government today, especially in, since the World T20 has gone and it was a great opportunity to engage in these online games. So now the government wants to capture your income, which was otherwise not being reported. It- So it has put in new sections, especially under your charging and under the TDS for your online gaming, winnings from online games. So in this case, they have also brought in a disclosure for 115 BBJ, wherein you have to put in what you have earned, whatever your income is during the year. While your TDS, that is under 194 BA, is applicable on your net winnings, any withdrawal which you make from any of your online gaming wallets will have to be subjected to this TDS as and when the withdrawal is made. Coming to the contributions made to political parties, in this case, a further disclosure is required where not just the amount, but at the same time, the transaction reference number, whether you have done it by UPI or IMPS, check, NEFT, RTGS, whatever be it, you have to provide your transaction reference number over here, and you have to mention the IFS code of the bank. This will essentially allow your bank or the income tax to trace your political contribution and ensure that such a contribution is declared by the political parties as well. This is a new benefit which has come under the whole startup benefit thing, where if under your ESOP plan, an eligible startup is issuing shares to you, such such ESOPs, rather such income from these ESOPs can be deferred. Earlier, what used to happen is, as and when ESOP is exercised, the income or rather the difference between your exercise price and the market price will be taxable in the hands of the assessee as salary income. What happens in this case is, if it is a marketable company, in that case I will be able to sell the shares, generate income, or rather generate cash flow to pay the tax amount. However, where certain startups are considered, these shares become non-marketable. It becomes difficult and they are illiquid. In that case, what the government is allowing us is that they are saying you can defer your tax or rather payment of tax by a few years. In this case, this deferment is allowed by section 191 subsection 2, which says that you can defer your tax payment for 48 months from the relevant assessment year, or till you cease to, or when you cease to be the employee of the particular company, or when you sell the shares. At this point, you have to now pay tax. But till then, you are allowed a shelter and you are not required to pay any tax on this amount. I will show you the disclosures of how the same has to be shown. Firstly, you have to show it under the salary schedule under 17.2, that is perquisites, which requires you to select this very specific thing in the drop down of nature of perquisites. It, it refers to stock options allotted or transferred by the employer being an eligible startup referred to in section 80 IAC. And after an hyphen, it tells you tax to be deferred. So this is the specific drop down which one has to select. And over here, the amount of your income should be mentioned. A specific schedule has been included in the later parts of your income tax return, where you have to give further information about the deferment of tax. So what happens is, in the last year, you had exercised such ESOPs. Now every year till the 48 months are complete, the income tax needs an update on what you have done with your ESOPs. So they will ask you over here whether you have sold these shares, or whether you have ceased to be employee of the company, or whether 48 months have expired since the end of the assessment year in which you exercise these shares. Accordingly, they will calculate, or rather, the income tax form will calculate how much tax is to be deferred and how much tax is generated in the current assessment year. This automatically again populates your Part B TTI, and you have to ensure that over here in 8A, B, and C, the numbers which are coming are correct, and that you are not taxed on the income which is deferred, and you might have to mention the tax amount which is also being deferred. These are now smaller changes which have come and which may be slightly esoteric, but are changes nonetheless. So in schedule, there's a new schedule for 80U for persons with disabilities, where a specific form, that is 10IA, is to be filed and mentioned in order to take the benefit of section 80U, and the details of said form have to be filed over here. UDID number is a unique disability identification number, which is given by the Department of Empowerment of Persons with Disabilities. It can be found over there, and if such number is not available, it is optional anyway. So the other impact of the same thing is in section 80DD, where the medical expense or maintenance for a person with disability is carried out by someone else. In this case, you have to mention that what kind of a relationship you have with the person with disability, and then further details about how such person can be identified. And of course, the filing and details of Form 10IA. Coming to other smaller points, now Scheduled OS has also included a change which allows you to report your dividend income, which you have derived from a unit which is located in an IFSC. Also, at the same time, another line item has been included where the declaration of bonus payments received under life insurance policies can be mentioned. So this is in line with an amendment under section 56 to 13, and therefore this line item has been included. Another amendment which was made by the Finance Act 23 was by an insertion of clause 12. So 56 to 12 now requires you to, so it's a chargeability of your income for the units held or any particular receipt towards these units. What used to happen is there used to be a double non-taxation, because certain units, or rather certain funds, used to make payments against the units as redemption of the face value. Now, in this case, being a capital receipt, or rather a receipt towards the face value, or rather the principal, it used to escape taxation. And at the same time, when the units were actually sold or redeemed, that time the cost of the whole unit was also taken at the time of computing your capital gains. So because of this, there was a double non-taxation. In this case, what the Income Tax Act has now brought in is that a small formula they have incorporated in this, called A minus B minus C. A being all the receipts which you have received from your fund, or rather towards the unit, minus B. B stands for the issue price of your units, and minus C stands for any amount which has already been taxed. So consider an issue price of 1000 where you have received 700 in this year. So 700 minus 1000 is minus 300, nothing taxable. In the next year, you receive 400 rupees now. So 700 and 400 is the aggregate amount which you have received. So that becomes A. So 1100 minus 1000. So this becomes 100 rupees, which becomes taxable under 56(2)(13) and is to be reported in Schedule OS, for which this amendment, rather this change has been brought in. Going one step further and completing the example, if in the third year you have received another 300 rupees, then in this case, 700 plus 400 plus 300 is 1400 minus 1000. Now this gives you 400 rupees. You have already paid tax on 100 last year. So again, minus 100 for the formula A minus B minus C gives you 300, and 300 becomes taxable under this section, and you have to mention it over here. There seems to be a particular wording which has come in the Income Tax Act this time, especially towards the bank accounts which are maintained by the assessee. In this case, while doing my research online and while talking to certain colleagues, I found certain confusion where the language now says that you have to report all banks with all bank accounts held. Now, this creates a confusion whether it is for during the previous year or ever held. So, giving the explanation, and I did some reading, and the income tax return is also pretty clear on this, that you have to disclose all the bank accounts that were held during the previous year. Earlier, the requirement was that you have to mention only those bank accounts which are held on the last day of the previous year. So please note this change, and where any particular bank account has been closed during the year, we would request you to ask specifically to your client if the client is new, or if the client is a regular client, then compare it with the previous income tax return and see whether any bank accounts which were mentioned in the last year have not been mentioned this year. Despite of that, still you must ask this question, because if a particular bank account was opened during the year and shut in the same year, then that might not come in your attention. So please ask this question. Now, this was all about the changes which have come in the income tax return. At the same time, there are certain nuances which one has to take care of while filing the income tax return, so as to not get any defective return or discrepancies or mismatches at the time of 143(1). What happens is 143(1) is directly populated with all the information that income tax department receives from various places. Now we see the AIS, TIS, how it is populated with the information from SFT, which it collects from all the various institutions. It is a huge data dump, and it links everything from everywhere. Therefore, it becomes all the more essential now that you provide accurate information, and where there is any particular information which varies from what is there in your AIS, TIS, then it has to be handled in a particular manner. Coming to the nuances, the first one being a very regular question that we receive as chartered accountants, that please create our balance sheet and P&L, or please make our balance sheet P&L. The person who is giving us a loan is asking for that. So it is not a requirement to maintain your books of accounts where you are going under the presumptive taxation. Therefore, no books need to be maintained, no balance sheet, no P&L. However, 4 specific items need to be disclosed at the time of filing your return, without which you might not be allowed to file the return. And in the unfortunate event that you are allowed to file the return without these 4 information, it will become defective return. Therefore, you must mention your debtors, creditors, stock and cash in hand at the end of the year, even if you are, especially when you're going under presumptive taxation. Where carry forward of loss for house property is concerned. Now, you can file your ITR if you have house property income under 1, 2, 3, 4, 5. However, if you are going under ITR 4, that is presumptive taxation and a house property income, then in that case, please note if you have house property loss and it is not getting adjusted in the same ITR return, and if you have to carry forward your loss, then do not file ITR 4. Rather, go for ITR 3 or 5, whichever is applicable to you. This is also specifically mentioned in your ITR form where you are taking your house property loss. Another mistake, or rather smaller nuance which we have noticed in the previous year, and something that few of our clients are going through because of, if you do not mention your ISIN at the time of filling your capital gain schedule, then you might lose out on the grandfathering benefit. This is only limited to the purpose where you have long-term capital gains. Next one is disclosure of pass-through income. In fact, today itself, when discussing with one of the partners of our firm, we came across this issue and we felt that this is a particular issue which the market also needs an understanding of. Pass-through income, especially from funds like AIF and business trusts, in which give are taxable for the income in their own hands, like interest, rent, etc. And then when they pass through this income, it is tax-free in your hands. In this case, it has to be disclosed correctly in Schedule PTI. Then also, if it is a capital gain income which has been passed to you, it has to be mentioned in capital gains schedule. And if it is, say, interest or rent income, it has to be mentioned in Schedule OS. Correct mentioning of this is very important. Schedule TDS will also require a breakup of the different elements where there's, so if you check your 26 AS, you will get a combined line item and it will say, okay, so and so fund has paid you this much, deducted so much TDS, and this is the amount of TDS. But if you have different incomes being shown in schedule capital gain or schedule OS, then your income tax department is not going to read it as one whole income and will not apply that one whole TDS to capital gains and OS themselves. Therefore, you must break it up for them and give whatever TDS is applicable to one element and whatever TDS is applicable to the other element. Otherwise, it might throw up a mismatch, and in 143(1), it will give you an unnecessary, demand. Details. So this was regarding your PTI. Now, when you are filing your income tax return, you have to give certain general information about the assessee. Therefore, in that case, you also have to provide compulsorily details of directorships, partnerships, and unlisted shares which are held by you. As partners in a partnership firm, you file in order to take benefit of section 10(2)(a), that is an exemption where your income was taxed in the hands of the partnership firm itself, and now you get the income tax free. In this case, you have to file the return and mention the nature of business that you are carrying out, because at the end of the day, partnership firm income coming to you is a business income and therefore has to be shown under the head PGPP. In that case, till the previous years, this particular option was not available, which is now available. So instead of selecting what business the partnership firm is doing, you can select why you are receiving a particular business income, and you are receiving this business income only because it is a share of income from a firm. Therefore, you select this particular option which I have mentioned over here, that is 00001 share of income from firm only. Then coming to individuals who are earning salary, while filing the form of a salaried person, the bifurcation which is mentioned in Form 16 should match with the ITR schedule at the time of filling the salary portion. This is primarily related to your salary components, because what we have noticed is people try to take an HRA after the whole breakdown is given by the employer, in which case this will throw a mismatch and create more problems. This, however, does not impact any Chapter 6A benefits which the employee may not have disclosed to the employer, but would have taken and genuinely invested in the correct places to take these benefits. This will not impact that. This is only relating to the salary breakdown, which should be mentioned correctly. Coming to the exempt income, when certain exempt income is earned by the assessee, especially an assessee where business income is there. So what happens is you create your PNL. The PNL final profit gets pulled into your Schedule BP by itself. In Schedule BP, now your exempt income is also being shown as the starting profit. In that case, you reduce your exempt income from the Schedule BP and go further ahead with your other disclosures. However, after doing that, you must ensure that you have disclosed your exempt income in Schedule EI as well. Because if these two things are not correlated and not matched by the income tax return, it will create another mismatch. Therefore, while it is a very simple thing, one must ensure that the Schedule EI is not overlooked, and wherever necessary, any exempt income which is earned by the assessee should be mentioned in Schedule EI. Coming to bonds and debentures, where such bonds and debentures which were purchased were come interest. That is, if I have purchased a bond in the 8th month and the interest payout is annual, then I am paying the seller the price of the bond, which includes interest for 8 months. After 12 months, the bond issuer will issue interest and I will receive the interest for the whole 12 months. In this case, what happens is this interest for 12 months is not my income. What is my income? It is the interest for 12 months minus interest for 8 months, which I have already paid. In this case, the problem which throws up is your 26, the bond issuer will not know that you have taken this bond 4 months here and there. Therefore, the whole of interest is given to you, and your 26 AS will show the entire interest income as your income and show the tax deducted in that case. What is to be ensured is at the time of disclosure, full interest is to be disclosed in Schedule OI, and then you take a deduction of the cost of the accrued interest which you paid at the time of purchase. Therefore, if 1,000 rupees of interest was received and 800 was accrued interest, then in Schedule OI, first you show 1,000 rupees as your interest, and in your deduction from under Section 57, you show you show another 800 rupees. Therefore, final income that you are paying tax on is only 200 rupees. Then I come to return verification. This particular problem comes up mainly when the return is not being verified by the individual themselves in case of individual returns, or as I think Ronak bhai will consider this later, but while I am mentioning where you are filing a company, then in case where there is an MD, the MD must verify it, and where there is no MD, any authorized person who is mentioned or is allowed by the company to file, such person is only supposed to verify the return. Otherwise, it becomes a defective return. Where certain income is earned at special rates, especially where your DTAA comes in or certain foreign income is there. In that case, you have to ensure that such income is correctly disclosed in Schedule SI. Normally, normally what happens is such income is automatically pulled into Schedule SI, but there are certain incomes where the rate is not mentioned because it could be dependent on the DTAA. Then in that case, you have to go and hand punch it over there um, in the schedule. Now, where certain TDS credit is earned in the account of somebody else and the income is mine, then in that case, such TDS credit since the last few years can be transferred from the return itself. In that case, your scheduled TDS provides you a mechanism where you can mention the details of the transferor or the details of the transferee, specifically in case where your clubbing of income comes into play. In that case, you have to file your, if I'm not wrong, SPI, your schedule SPI, where you have to mention details of clubbing. Now, what one normally does is, if there is income of my son being clubbed in my return, I will just file my return and I will take the income in my return, show the TDS, everything, and close the matter. But what happens is, since I have not filed the return for my son and provided in the schedule that so and so TDS is being transferred to so and so PAN, in that case, a mismatch will throw up and I will not get the credit of the TDS which is there in my son's account. Therefore, it has to be ensured that the transferor of the TDS and the transferee of the TDS both mention this detail of transfer in their scheduled TDS. Coming next to a particular issue that has been around since the last few years and must be mentioned year on year so that this mistake is not made, because if this mistake is made between filing your schedule AL and your schedule FA, it is a very heavy price that one has to pay. Coming to schedule AL, one normally correlates this to your balance sheet and P&L schedule. I would like to mention at the outset that both are separate, mutually exclusive of each other. Where Schedule AL is concerned, only a person having total income higher than 50 lakhs is supposed to fill this. And all the details which are mentioned in this are to be mentioned at cost. The liabilities or other any loans, etc., which are taken by the assessee in respect of the assets which are mentioned above only have to be mentioned. Any other liability taken on by the assessee is not to be mentioned over here. For example, if you take a personal loan for a trip that you want to do, in that case, such liabilities need not be mentioned over here. However, if you have taken a loan to purchase certain paintings or certain immovable properties, in that case, yes, the liability has to be mentioned. Where your ITR 3 is concerned, you have to file your balance sheet and P&L in case you are not taking presumptive taxation or are not a salaried person. This is to be done whether or not you have to file your schedule AL. Coming to the next point of foreign sourced income, where there is any foreign sourced income and you want to take the benefit of FTC, that is foreign tax credit, you have to first file your details of your income in scheduled FSI. At the same time, Form 67 has to be filed before filing your income tax return in order to take benefit of foreign tax credit, excuse me, in order to take the benefit of the foreign tax credit. Therefore, please note, without filing Form 67, you will not be able to take the benefit of foreign tax credit. Coming to the one of the most dangerous schedules that exist in the income tax return if overlooked, Schedule FA. Schedule FA talks about the foreign assets which a person may hold. In this case, you have to mention very peculiar details, very particular details, whether or not the assessee directly in their own capacity holds these, or whether the assessee is a beneficial owner of such assets. The details of these assets have to be given as on 31st December of the previous year, and accordingly you have to provide proper details, because income tax department today has, or rather our government today has entered into various agreements with different countries where information sharing is a very big element. Therefore, information which is shared by the foreign countries about you, if not mentioned in your income tax return, can lead you to a dark hole of black money and PMLA. Therefore, better to file this. Coming to what actually you have to mention in your Schedule FA, details of any depository accounts which may be held outside India, details of any foreign custodial accounts, which again, both these accounts, at the time of disclosure, you have to mention when the account was opened, with whom it was opened, and what was the peak balance during the year in these accounts. So one particular requirement of peak balance is it comes from your Black Money Act, because they will be able to levy penalties on the basis of this. Next is your foreign equity and debt interest. So you have to mention the entity in which you hold your foreign equity, your foreign debt, to whom you have given debt. Then the details of investment will include the cost of your investment, the initial value of your investment, peak value of your investment in the current year. Then whether or not you have sold anything in the current year, and what other receipts you have received from this investment, be it interest, dividend, etc. In the There's one very particular thing also regarding insurance that one has to mention over here. If you have any particular foreign cash value insurance or annuity contracts, then details of these contracts also have to be mentioned in your return. Details of financial interests in any entity, any immovable property, or any other capital asset held outside India need to be mentioned. Now, these are three different schedules which I have combined in one, since they have the same information which is asked for, basically details of the entity or the property or the capital asset, nature of the interest that you hold in such a entity or immovable property, what kind of income was generated in the current year, and whether or not such income is disclosed in your ITR, and where it has been disclosed. So these informations have to be mentioned in these clauses. What is peculiar is, in this case, any other capital asset is covering a broad spectrum which is not covered already. But at the same time, you have to mention where. So, okay, I'll come to that later. In the next question is details of accounts in which assessee has a signing authority. As we already know, where a person has a signing authority in account in a foreign country, in that case, that person already has to file a return. You also have to mention it over here where you have such signing authority. This brings me to one very particular thing which one should be careful about. If you are an employee of a company where the company has a foreign account and you are a signing authority in that account, and now you resign from the company. You have to be very careful that your name has been removed from such signing authority, and where due to some overlooking or any other lapses it has not been removed, then all the details which are required over here should be received from the company. Because if you do not, if you are not a part of the company and you still have the signing authority, what happens is you might not have access to that bank account, you might not have access to the statement. In that case, you will not know what the peak balance or the gross interest earned during the year is. So one has to be very careful about such things. Next is a very important portion, where if you are a trustee or a beneficiary or a settler of any trust, any foreign trust, then in that case, you have to provide the details of the trust. Not just that, if you are a trustee, then you have to give details of all the trustees, all the beneficiaries, and the settlers of the trust. If you are the beneficiary, you have to provide details of all the trustees, settlers, and other beneficiaries. So, in a sense, income tax is taking all the details of the foreign trust from each and every Indian person who is part or required to file this Schedule FA. In that case, whether the income from such trust is taxable in your hands is also to be mentioned. How much income is taxed and where such income is disclosed in the ITR is also to be mentioned. All of these till now related to some or the other asset held outside India. Now, one particular thing also is asked, whether any income is derived from any other sources which are not covered above. The points which we just saw about Schedule FA, if there is no income which is falling under that, but is falling somewhere else, then in that case, you have to specifically mention it over here. Now, one may have entered into certain contracts outside India with certain parties, which, it could be a variety of certain creative contracts. In that case, the income tax department may not be able to name them specifically. So they ask you to declare it over here. So such income has to be declared if not found any other place over here. And that brings me to a close towards my points from the changes in ITR 1, 2, 3, and 4. Thank you.
Thanks, Akshar. There are a few questions. I think we'll keep the questions at the end of the session.
Sure.
I'll ask Ronak to continue for ITR forms 5, 6, and 7.
Thank
Over
you.
to you, Ronak.
Yes, good evening, everyone. Myself, Ronak Rambhia. Belated Chartered Accountants Day to one and all viewing this webinar. I would like to welcome all the viewers to this webinar on filing of the income tax return for this assessment year 2024-25. Also, I would like to thank the BCS and the tax committee for giving me and Akshar this opportunity to give our views on filing the income tax return for this assessment year 24-25. So yes, the logo of our IT filing portal says e-filing anywhere, anytime. But I would like to make it as it should be e-filing, disclosure everywhere, all the time. So that is how our income tax filing season will go, with all the disclosures everywhere. You all have heard for about 60 minutes of Akshar, where you have seen how disclosures is important in the income tax return filing. Further, just some basic things. Now our income tax portal is incometax.gov.in. Currently, it is under the JSON-based schema. Earlier, it was the XML-based schema. So JSON is the JavaScript object notation scheme. It is a better data interchange format, which is better than the XML, and that's how income tax has moved on to this JSON, which is better for the disclosures and everything. Also, one more thing I would like to add, since we are all chartered accountants and other viewers for the benefit of all, that Institute of Chartered Accountants of India has also launched this Chat GPT today, especially for the chartered accountants. One can take the benefit of it. You can ask questions and it will give you replies based on the Chat GPT that Institute has released. So Akshar has taken from ITR 1, 2, 3, 4 and some of the key amendments and everything. I would then take it further from here. So what topics which I'm going to cover is the important due dates, the applicability for ITR 5, ITR 6 and the ITR 7, the prerequisites for filing of the income tax return, some of the key amendments in the tax return. There are some important schedules in the tax return, and important validation points to avoid additions in intimation under section 143(1)(a). Here I would like to only add that the hardest thing in the world to understand is the income tax, which in fact our Albert Einstein has also said it. So income tax is something which one would take years to understand. Going further, so these are some of the Tariq pe Tariq, I would say, due dates for our chartered accountants and the people in the profession. So yes, coming after about 30 days is the 31st July 2024, which is for the tax return for non-audit cases. This is for all assessees except the corporates. This is your original return, and you will be given chance to file, revise, belated, updated, all those return. But this is the original return due date for all assessees except corporates and for whom audit is applicable. 31st August 2024, charitable trust have to file Form 9A, Form 10. So 9A is basically 9A is application of income of previous year in subsequent year, where you can make an application to the income tax for the income of previous year, which you are spending it in the subsequent year. Form 10 is for accumulation of income for future application for 5 years. So this is for on 31st August 2024, the charitable trusts are required to do these compliances. Then comes the 30th September 2024 deadline, which is for the tax audits, Form 10B, Form 10BB, 29B, and other applicable specific deduction forms. For example, if you are claiming deduction under Section 80 JJAA, you have to file the Form 10DA. If you are claiming under Section 10 AA, you have to file the Form 56. And there are other various forms which one has to carefully analyze, or which forms are to be filed before this due date. So here the only interplay is there are some forms which are to be signed by a chartered accountant, and that has to be filed with the income tax department. So here the client appoints a chartered accountant. The chartered accountant has to accept it. Chartered accountant has to fill the whole form online or as the utility makes available online. And then the assessee has to accept that same form before filing the tax return. Further, then would come the 31st October 2024 due date, which is for the transfer pricing report. Here, transfer pricing may be both international and domestic transfer pricing. Also, the 31st October is the date for the original return for the tax audit cases, where tax audit is applicable or audit under any other act is applicable. The due date for those tax returns would be 31st October 2024. If I have to mention other audits, means audit under Charitable Trust Act or audit under LLP or audit under cooperative society, everyone is eligible to file by 31st October 2024. Once the transfer pricing reports are filed by the assessee, then the tax return for those assessee has to be filed by 30th November 2024. This is for all the original returns. Once the original returns have been filed, one can file a revised return for the said assessment year 24-25 by 31st December 2024. Or if you've not filed the original return, you can still file a belated return by 31st December 2024. That is 9 months from the end of the assessment year. Still, you have not filed the income tax return by 31st December. Now there is updated return. for assessment year 24-25, you can file the income tax return by 31st March 2027. Now, which returns are applicable for which assessees? We go further saying which returns are applicable to which assessees. So this is ITR 5. I would call it as a residuary ITR. It is an ITR which mentions that this for whom it is not applicable. So for persons other than an individual, an HUF company and a person filing ITR 7, Akshar has well versed everyone with it. So partnership firms, limited liability partnerships, association of persons and body of individuals. So here it would be a private trust, a private discretionary trust, gratuity trust, a PF trust, which are have to file the ITR 5. Also, in case of deceased or insolvent, this is the correct ITR to be filed. That is the ITR 5. And the business trust and the investment funds also have to file this ITR. Here, only a small pause saying that for partnership firms which are claiming under section 44 ADA or 44 ADA only, then they will have to file ITR 4. That is the presumptive taxation form. So one has to go back to an ITR 4 by the partnership firms if they are claiming under section 44 AD or ADA. Then comes the ITR 6. Yes, it's the test match income tax return because it's the longest income tax return currently. This is for the all companies other than the companies claiming exemption under section 11. So this is for all the corporates that this return is applicable to them. And yes, the ITR 7, the very spoken about ITR is the ITR 7, which is applicable for a person who are applicable under section 139 4A, 4B, 4C, and 4D. So here 139 4A is for persons taking benefit under section 11 and 12, that is the charitable trust. 4B are the political parties. 4C are persons taking benefit under section 10 subsection. So there are various subsections in this section 10 which are liable to be filing the income tax return in ITR 7. And under 4D, which are the university, colleges, or institutions referred to in clause 35.1.2 or 35.1.3. So here, various sections of section 10 have to file ITR 7. Further now, going ahead, what are the ingredients or I would say the prerequisites for ITR 5? Here is the audited or unaudited financial statement. So in this, since the partnership firms who are not liable to audit, or if there is an LLP which is not liable to audit, so here you have unaudited financial statements. So unaudited financial statements or audited financial statements as applicable. The tax audit reports, the income tax forms. So I'm not talking about the income tax return, but the income tax forms which are applicable to the partnership firms or the LLPs or other assessees. The list of partners, members, beneficiary. So here, the firm or the LLP would require the personal detail, that is the name, address, the PAN, the remuneration, the percentage of share, and the DPIN for LLP partners. So here these details are required to be mentioned in the income tax return. For the AOPs or societies, you are required to mention only the details of the managing committee. Then comes the nature of business codes. One has to see what is the assessee business into and accordingly choose the appropriate code. And for this, only one suggestion which I would like to bring is for cooperative societies, when you are claiming deduction under section 80P, that is for interest from cooperative banks or other credit cooperative societies, you have to mention the code as 23011. This is somewhere people do not have this knowledge of the specific code, but now I think the income tax has given this specific code for cooperative societies for claiming benefit under section 80P. Further, yes, the 26 AIS, TIS reconciliation. I would only let you know that AIS has currently these 5 heads. Basically, is the TDS, TCS information, the SFT information, the payment of taxes made during the year, demand and refund activities during the year, and other information. So here, how does the AIS and TIS works is AIS collects for TDS, TCS information from the 26 AS portal. SFT information, once all the applicable assessees have filed the SFTs, returns, annual return, then that details are compiled and you will see the details of the dividend, the details of the saving bank interest, the income tax for interest on FDs and the capital gain, which are mentioned in this. And thereafter, you would have the payment of taxes. The demand and refund activities are also mentioned in this AIS. So one has to verify these details before making the while making the tax computation. And yes, the GSTR turnover also is required. So for assessees who are having multiple GST registrations, you should have GSTN wise turnover for the specified assessee. Then comes the prerequisites for ITR 6. Yes, this is for the corporate. So you would require the audited financial statements along with the audit report, because you require to mention the date of the audited financial statement. Nowadays, we prepare financial statements in either thousands, lakhs, millions, but income tax return still requires full figures. So one should have the working of the financial statements in full figures. Then comes the tax audit report, the income tax forms which are applicable for the requisite company, the list of directors, the list of shareholders. Currently, this is not required for a listed company. The Form 26 AIS, TIS reconciliation, and the GST and turnover, which is the same as we discussed earlier. So here one needs to check from the minutes also the list of the directors, the movement of the directors, as in the directors held directors on the board of the company anytime during the year have to be mentioned in the ITR 6 form. Further, now we'll go into some key amendments in the ITR. Akshar has taken through most of the amendments. Some of the amendments which I would like to touch upon. One is the legal entity identifier. Yes, so currently RBI has come up with this LEI, which mentions that the remitter and the beneficiary LEI information must be included in any single payment transaction involving an entity that exceeds rupees 50 crores. So this is true for financial transactions made using RTGS and NEFT payment systems. The new ITR form features a field for providing this LEI number data to comply with the RBI rules. So all the assessees who have the LEI number are required to mention this in their income tax return. Further, if your tax refund is more than 50 crores, then obviously it's a mandatory field for you to mention the LEI number in the income tax return. In case of tax audit reporting, the sales turnover details for the reason for furnishing the tax audit report, as Akshar has mentioned, that whether for the 5% of the cash transaction, your turnover changes from 2 crores to 3 crores. So for that reason, you require to mention the sales turnover detail, the acknowledgement and the UDIN of the tax audit report. So currently it is only for the tax audit report that you are supposed to mention the UDIN in the income tax return. Other forms UDIN are not mandatory currently in the income tax form. Further, in case of MSME, once the payment are done beyond the prescribed period, in part OI, that is part other information, you have to mention the details of the MSME payments made beyond the prescribed period. And the MSME registration number of the assessee is required to be mentioned in the part A general item, where we normally mention the basic details of the assessee. There the MSME registration or number also currently now needs to be mentioned in the income tax return. Some other key amendments like the capital gain account scheme. Earlier you had to only put the amount, and now you have to put the date of deposit when you've deposited in the capital gain account, the account number, and the IFSC code, and obviously the amount of deposit made in the capital gain account scheme. Now in this, when you are opting in the new regime, so the new schedule now allows you, as in the depreciation schedule now allows you to adjust the unabsorbed depreciation pertaining to the additional depreciation from the WDV of the block of assets as on the opening date, that is 1st April 2023. So, for example, in ITR 3 and 5 in the schedule DPM, which deals with depreciation on plant and machinery, it provides that the WDV of the block of asset as on 2023 can be amended, and it shall be increased by the amount of unabsorbed depreciation pertaining to additional depreciation, which was not allowed to be adjusted on opting for new regime under section 115 BAC. So one has to carefully look through it if they are opting for the new regime. Then whether the unabsorbed depreciation has an element of additional depreciation in the earlier income tax return. So that adjustment will have to be done in the opening WDV of the block, and the type of accounts which are to be mentioned in the income tax return. So here now you have to mention which type of accounts are maintained by the company. The current account, overdraft account, CC account, savings account is also required to be mentioned in the income tax return. There is one new schedule, which is schedule 115 TD, which is reporting tax payable on the accreted income. Yes, so if an entity such as in a Section 8 company or a trust which gets converted into a form that is not eligible for registration under Section 12AB or approval under Section 1023C, it will be ineligible to file its income tax form under ITR 7, and it will have to pay tax as per the normal provisions and report such income in the ITR 5 or ITR 6. This schedule requires various details such as the computation of the accreted income, that is the fair market value of all total assets as reduced by the total liability, then the tax payable on such accreted income, and the mode of payment, that is the details of the challan for the deposit of the tax on this accreted income. So this is for SSEs which are opting out or which are ineligible to claim deduction registration under Section 12AB or 1023C. In this Finance Act of 2023, there has been one more addition of 115 BAE. So option 2 opt for concessional regime under Section 115 BAE for cooperative organizations has been added. It is a novel tax plan for resident cooperative organization involved in the manufacture or manufacturing of goods. So if a cooperative organization chooses to implement this plan, profit will be subject to reduced taxation if specific requirements are met, that is specified conditions in the provisions are met. Then one can take the benefit of a concessional regime under Section 115 BAE. There are more amendments which I think Akshar has covered it, so I will not be repeating it. And so going ahead with this analysis of ITR 5 and ITR 6. So here the structure of our income tax returns are where you have the Part A, Part B, and the schedules for it. So Part A is basically the general information, the auditor's information, auditee details, registration details, and others which are mentioned in the first 2-3 pages of the income tax return. Then you have the balance sheet details. So you have to select which accounting standard is applicable to your assessee, that is whether it's an AS or an Ind AS, and accordingly you have to fill the balance sheet only either for AS or for Ind AS. Consequently, you have to file you have to put the details of the manufacturing account, the trading account, the profit and loss account as per the financial statement of your clients. Then comes the other information which is mandatory for the tax assessees to whom tax audit is applicable, and this is the schedule which is normally matched with the tax audit report by the income tax department. Also, there is quantitative details which is also applicable in case of tax audits. Quantitative details currently is the trading account details, the manufacturing account details, which one has to mention about the quantity details movement during the year. So here in the schedule OI is only the adjustments, the additions, deductions which are to be made to the net profit to arrive at the taxable profit. So this is the more or less the structure of the income tax return. We'll see further some of the important schedules in our income tax returns ITR 5 and 6. So all of us would be filing these income tax returns since years. So there is 5 heads of income, which is the schedule HP, BP, capital gains, salary, and other sources. In ITR 5 and 6, there is no salary. So these are the 4 income schedules. And important one over here is the schedule 112A. Still, there is a hue and cry for mentioning the sale of equity shares in a company or a unit of equity oriented mutual fund or unit of a business trust on which STT is paid under section 112A, where you have to mention the ISIN number for taking the benefit of the grandfathering clause. Also, here you have to mention the periodicity. You have to classify the securities based on the periodicity. The category of the assets sold is also important for one to by making the computation of total income. Then comes the schedule VDA, which is the virtual digital asset schedule. Here one has to put the income earned from the transfer of which virtual digital asset. Further, from this schedule, it goes to either the business income or the capital gain as applicable to that specified virtual digital asset. In ITR 6, here I just wanted to make a noting that ITR 6 currently has OS schedule, which has income from savings bank also. I doubt if any corporates still have savings bank, as in whether RBI allows corporates to have savings bank, but being a column, one has to at least put a 0 over there. Further, then there other schedules are the carry forward losses, brought forward losses schedule. So here in CYLA, the income of the current year and the losses of the current year are set off first against each other. Then you have the brought forward losses schedule, wherein the incomes of the current year are set off against the unabsorbed brought forward losses of earlier year. And then you have the carry forward schedules, wherein any loss of the current year which is not set off is carry forward to the future years. You have the ICDI schedule. ICDI schedule, here you have to mention whether it is increasing the profit or decreasing the profit. One has to be very clear whether this is increasing the net profit or decreasing the net profit. Your tax auditor and your income tax return amount should match with each other to have no other 143(1)(a) addition. So this one has to put in the correct column of increase in the net profit or decrease in the net profit. It is assumed that you have to give a net impact in this schedule. Further, then there is a schedule SI, which is statement of income, which is chargeable to tax at special rates. Yes, you have a lot of rates in our income tax return. So you have to mention each income specifically at special rates. Then you have the schedule EI, which is the schedule of exempt income. Here one has to match whatever is written in other schedules as exempt income. All have to be mentioned is schedule EI. A simple example is income under the concept of mutuality for cooperative societies. Whatever is mentioned in schedule BP for as income under the concept of mutuality needs to be mentioned in schedule EI also. You have pass-through incomes also which are exempt, which also needs to be mentioned in the schedule PTI and schedule EI. Yes, there is pass-through income schedule also, which is the for when you receive the details from the business trust or investment fund. We will see the pass-through income schedule in detail in further slide. You have the schedule MAT and AMT, which is the computation of minimum alternative tax if you are still in the old regime under section 115 JB. Important other schedules is the schedule TR, that is when you have to claim the foreign tax credit in your tax return. This is the details of foreign income earned, and you have to claim the withholding taxes of the assessee in the foreign country. You have to mention the details in this schedule TR. One check over here is one has to file the form 67 along with the requisite attachments, and then you have to file the same details in the tax return to claim this withholding taxes. Then comes the schedule FA, that is the details of foreign asset. Akshar has given a very well detailed thing for these details of foreign assets and income from any other person outside India. Then you have the schedule GST, which mentions about the GST return details. So here one normally has the question of whether the annual turnover has to be put as per the books of accounts or as per the GST return. Obviously, there are reconciliations and various other adjustments which require to reconcile the books of accounts turnover and the turnover as per the GST records. So here, if you see the schedule mentions that annual value of outward supplies as per the GST and returns filed. So one has to mention over here the GST turnover returns as per turnover as per the GST return. Then comes obviously after collecting from all the schedules, it makes your part BTI, that is the computation of total income, and the computation of tax liability on total income. Then you mention the tax payments, that is the advance tax, the self-assessment tax, the TDS, the TCS, and other taxes paid. And then comes the verification for these returns. So one has to so company returns have to be verified by the managing director if applicable, or by an authorized person, and they require uh, the DSC of that person. ITR 5 can be, for non-audit cases, can be still done by non-audit cases can be still done by Aadhaar OTP, but for others you require the digital signature of the person verifying the income tax return. Now, some specific schedules in ITR 6 is the schedule BBS, that is the details of tax on distributed income of domestic company on buyback of shares not listed on stock exchange. Then there is schedule SH1, which is the shareholders detail, where you have to mention the movement in the shareholding. This is again applicable for unlisted companies only. Then there is schedule AL1, that is the asset liability schedule at the end of the year for unlisted company, and schedule FD. So this is not applicable for companies having tax audit. So if the company is having tax audit, then this is not applicable. If it does not have a tax audit, then the schedule, that is the breakup of the payment and receipts in foreign currency, where you have to mention the nature also, that is whether it is a capital receipt, foreign receipt, or capital expenditure, or foreign expenditure accordingly. So some of the important schedules over here where we would like to discuss is the schedule AL, which is mentioned in the ITR 6. So here you have to mention details of the residential land and building. These are the items which are mentioned in residential land and building and other land and building. You have to mention the particulars, the date, the cost, the address, and the purpose for which the such asset is used by the company. There is a drop down available in the income tax return, and one has to wisely choose which purpose is the as land and building used by the company. Then you have to mention the details of the listed equity shares, unlisted equity shares, and other securities. This also includes the movement in from the opening balance to your closing balance. That is the movement during the year, where you have to mention what is the opening balance quantity as well as the amount, and the purchase quantity amount, sale quantity amount, and the closing balance quantity and amount. In case of unlisted company, you have to mention whether it is unlisted new acquisition is done by fresh issue or it is purchased from another shareholder. So for unlisted equity shares, one has to mention this. Then obviously you have the capital contribution in other entities also have to be mentioned. In case of loans and advances, one has to mention the movement also, that is the opening balance, amount received, amount repaid, interest charge, interest percent, and then you arrive at the closing balance of the loans and advances. Vehicle, aircraft, yacht. Yes, in India, there are a lot of companies who owns yacht and aircrafts also. So aircraft and yacht details are also to be mentioned. But here you have to mention the date, the cost, the registration number of these vehicle, aircraft, yacht, and the purpose for which such assets are used by the company. Then there are jewelry, bullion, artwork also details which are to be mentioned in the schedule here. Then comes the liability side, which mentions that you have to mention the liability relating to above assets other than the liabilities from any other financial other than the financial institution. Here also one has to mention the movement in the liability schedule. Then comes the schedule for the shareholders. Here one has to mention the key person's details. That is the details of the managing director, director, secretary, principal officer, including the DIN numbers of these persons. Then comes the shareholders information, wherein you have to mention who are the beneficial owners of shareholding, not less than 10% of the voting power at any time during the previous year. And in case of unlisted company, you have to mention details of the natural person who are the ultimate beneficial owners, directly or indirectly, of shareholding not less than 10% of the voting power at any time of the previous year. So if you have layers of investment of your client or of your assessee, you have to mention who is the natural person or the ultimate beneficial owner of your corporate assessee holding the said equity shares more than 10% of the voting power. Here one can refer to Ben 1, Ben 2 form, where corporates have to file the beneficial interest form with the registrar of companies ROC and can get these details for the income tax return also. Then you have the shareholding of the unlisted company, where you have to mention about the movement of the shareholding. That is the name of the shareholder, whether it is a resident, non-resident, the type of share, other details, number of shares, face value per share, issue price per share, and the amount received by the company on issue of such shares. Also, when there is a transfer, the company has to give the details of the shareholder who has transferred this and the person, and in case of transfer, it has to give the PAN of the new shareholder to which the shareholder has transferred the said equity shares during the year under review. So for this year, also the day application money pending allotment at the end of the previous year also needs to be mentioned in the income tax return. Then yes, the schedule PTI, that is the pass-through income. So here I've just explained what is the PTI. That is, you have a unit holder investor who is investing in the fund. That is investment fund. It can be a category 1, category 2, category 3. So here, if in case of category 1 and 2, you get income from the fund. So for the unit holder, investor unit holder, all income is taxable in the hands of the unit holder except PGBP. And in case of the fund, PGBP income is only taxable in the hands of the fund. One can refer to Form 64C, which is normally given by the investment fund houses to the investors, and accordingly fill the specified schedule. The schedule PTI is also mentioned here, where one has to give the details of the business trust, the PAN of that business trust, and the detailed income, house property, and the corresponding TDS of such income. So when you are filling the TDS schedule, you would get only one line item where you have income from the business trust under section LBB, and you would have one income. You have to break that income into the specific schedule, and also in the TDS schedule, you have to break the same income and same TDS in the same manner in the TDS schedule for it to match. So here there are 3 reportings. One is you will do in PTI, you will do in 26 as in the TDS schedule, and also in the specific schedule, that is the house property, capital gain, other sources. You have to mention what income is from the pass-through is as pass-through incomes, which is to be mentioned also. Category 3 income tax is income is tax-free in the hands of the unit holder, so it has to be mentioned as exempt income over here. Some of the important validation points I thought I would like to share with you all, where 143(1)(a)s are considered by the department. These days they are verifying it, and this is pure number based game, where the tax audit report clause and the ITR clause is verified, and accordingly the ITR is processed, and you get an intimation either with demand or you get a higher tax payable thing. So the clause wise, I would like to explain, that is amount not credited to the profit and loss account, which is clause 16 of the tax audit report. Same has to be mentioned in clause 5 of the tax return. Amounts debited to the profit and loss account, which is disallowable under section 37, which is as per tax audit report clause 21A, has to be mentioned in clause 7. amounts debited to the profit and loss account to the extent disallowable under section 40, which is normally in the clause 21B of your tax audit report, you have to mention in clause 8 of part OI of your income tax return. Then amounts debited to the profit and loss account to the extent disallowable under section 40A on account of TDS, the amount is in clause 21B or clause 23, which has to be mentioned in clause 9 of the income tax part OI. Further, any amount disallowed under section 43B in any preceding financial previous year, but allowable during the previous year, which is the 26A clause of the tax audit, has to be mentioned in clause 10 specifically in the income tax in schedule OI. Then amount debited to profit and loss account, but which are disallowed under section 43B during the year, you have to mention, which is mentioned in clause 26BB of the tax audit, has to be mentioned in clause 11 of the income tax return OI. Any amount of profit chargeable to tax under section 41, which is in clause 25, has to be mentioned in clause 14 of the income tax return. Income or expenditure of prior period credited or debited to the profit and loss account is 27B, which is clause 15 of your income tax return. And amount of expenditure disallowed under section 14A, which is in clause 21H of the tax audit report, has to be mentioned in clause 16 of the income tax return. So this year income tax has also given these validation rules, which is mentioned in this table as if you can download this from the income tax portal in the downloads column, which is mentioned as the validation rule, which is there for all the income tax returns, and one can see through for better understanding of these validation rules. Further, that is for the charitable trust. So some ingredients for this ITR 7 is the audited financial statements along with the audit report under other acts, that is the charitable Indian Trust Act or Maharashtra Public Trust Act as applicable. Then comes the form 10B or 10BB, whichever is applicable to the said trust. The income tax forms which are applicable to said trust. The details of the registrations, that is the details of 12AA, 80G of the said trust, have to be mentioned in the income tax return. Form 26AS, AIS, TIS reconciliation is required, and for trusts which are having GST turnover also, GST and wise turnover is required for multiple registration for the income tax return. So here, if I have to discuss the schedules of the income tax in the income tax return 7, so here also you have part A, part B, and other schedules. Income tax return of trust itself is a separate subject by itself, but I will still go through the important schedules. Whereas the part A is the general, where you have to mention the details of the trust, the registration details, and the other details of the auditors in this part A. Then comes the schedule I, which is the details of the amounts accumulated or set apart within the meaning of 11.2, that is the corpus fund collected by the trust. Then comes the schedule J, which is statement showing the investment of all the funds of the trust or institutions as on the last day. So the corpus or the funds which are set apart have to be invested in specified mode, and these details have to be mentioned correctly in this schedule J. Here in the schedule I and schedule J, you would have the bifurcation as in first April, before 1st April 2021 and after 1st April 2021, which is when this new provisions of charitable trust have come in, and one has to give the details accordingly in specified column. Then comes the part A BS, that is the details of the application and sources of fund as on the 31st March 2024. Then R is the reconciliation of the corpus of schedule J, which is mentioned about, and the balance sheet. So you have to give the details of the corpus of the charitable trust. Then there is schedule VC, which is the details of the voluntary contributions received during the year by the charitable trust. Then you have schedule AI, which is the aggregate of the income derived. So here you have the income derived during the year, excluding the voluntary contributions during the year. Then where this income has been applied has to be mentioned in Schedule A against stated objects of the trust of the or the institution as applicable, and this has to match with your income and the expenditure account. Then further you have based on the above schedules, the income tax return will collate the computation of total income, where it will give the gross sources of fund and the application of fund, and accordingly the computation of total income is prepared. You have the applicable exemption which is claimed under section 11 and 12 in part B1, and then tax computation of tax liability, if any, is computed in part BI, and then is the verification. Here in ITR 7, trustees or the authorized persons can verify it through Aadhaar OTP or through sending it to CPC also, or through DSC if available. It is not mandatory for all the trustees to have digital signature in case of trusts. So I think this is for the ITR 7. Further, then there is income tax returns. You would have the revised return, the belated return, the updated return. So one can file revision or belated returns uh, can be filed with before 3 months from the end of the assessment year. That is, as we discussed, for assessment year 24-25, one can file up to 31st December 2024. The further brought forward and carry forward losses is not available in these returns, except unabsorbed depreciation is allowed for belated return. Here also you cannot file a new form for response to defective ITR, but new form as in the new ITR is allowed for revised return. You can change your ITR from 1 to 7 or 1, 2, 3, 4, 5, 6, 7. You can change in case of a revised return, but it is not allowed in case of defective return. You can now have an updated ITR also, that is the ITR A, ITR U, which is as per section 139(8)(a), where it can be filed within 24 months from the relevant assessment year, which is within an additional tax liability as 50% or 25% as the case may be, which is mentioned in the FAQs also. So when can you file these updated returns is if you have not filed an ITR previously, if you have income not reported correctly, you have wrong heads of income chosen, you have reduction of carry forward loss, you have reduction of unabsorbed depreciation, reduction of tax credit under section 115 JB or JC, you have wrong rate of tax applied or any other reason. So here you cannot you have to select for which reason you are filing this updated return. So some cases in which you are not allowed to file an updated return is you cannot file an updated return for as a return of loss. It cannot result in a tax refund or decreasing the current tax which is filed in your original belated revised return, or it cannot increase your refund for the relevant assessment year. It can be furnished only once for relevant assessment year. If you have search or survey initiated, you cannot file an updated return. If you have any proceedings which is initiated, pending or completed for an assessment year, you cannot file an updated return in such cases. If an AO has information in respect of such person under Money Laundering Act or Smugglers Act or under Section 90 of Income Tax Act, then the same has been communicated to the assessee prior to filing of updated return. The assessee is not allowed to file an updated return. Further, in case of ITRU, if it is filed within 12 months from the end of the relevant assessment year, you have to pay 25% of the additional tax plus interest. And if it is filed after 12 months, but before 24 months of the end of the relevant assessment year, one has to pay 50% of the additional tax and interest. So here, only a thing where you can file your income tax return up to 31st December 2024 as a original return or a belated return or a revised return. Then from January 25 to March 25, you cannot file an income tax return for assessment year 24-25. Then you get an option to file an updated return only after April 25, wherein you can file the updated return for assessment year 24-25. So this is on about updated return. Further, some important points is the claiming of the TDS, which is obviously the TDS or the TDS as one would read it. So here I have taken some instances for claiming or the corresponding incomes or mentioned in. So for instance, you have income in year one and there is corresponding TDS in subsequent years. So assessee now can e-file Form 71 as application for claiming the said TDS credit along with supporting documents and mentioning the requisite details in the form. So you have income in year one, but TDS is in year two or in subsequent years. You can file, one can file Form 71 and mention the details, and the income tax portal is required to reprocess that return and give a intimation under section 154 and give the correct TDS credit. The time period for this filing of Form 71 is 2 years from the end of the financial year in which TDS was deducted by the deductor. So these days we have seen where one company is following the principle on accrual basis, has made the sales, but the TDS is deducted by the recipient in second year when the bill is processed by the opposite party. Then if one can take now the benefit under Form 71 and do the necessary compliance for claiming the correct TDS. Second instance is TDS is in year one and the corresponding income is in subsequent year. So in case of chartered accountants only, I would like to say that where your clients are deducting TDS on accrual basis, and most of the chartered accountant firms follow the principle of cash basis. So only when the bill is issued and the money is received is where you are claiming the TDS. So here one has to carry forward the said TDS credit. For example, you have TDS credit in year one, but the income is in year two. So in the year one return, one has to carry forward and not claim the TDS credit. And the assessee is eligible to claim this TDS credit in the year two, in my example, when it has offered this income to tax in the profit and loss account, and the correct head of income is to be mentioned in the income tax return while filing. So this say for these you can refer to rule 37BA or section 155 subclause 20 for understanding these TDS provision. Further, for example, if you have TDS in one person, but you want to claim that same TDS in another person, as Akshar has also mentioned, now you can mention this detail in the income tax return itself, wherein it asks you of the PAN and the details of the person to whom you want to transfer this TDS, and the recipient person also has to mention the details from whom this TDS is come to this person. So this is, I thought, some of the TDS things I would like to share. So here these schedules and income tax returns is what we've discussed. So now a final checklist, since you are on the end of we are in the start of the filing season. So you some checklists like the user ID password have to be properly collected before making the income tax return. You have to update your profile. You have to update the key personal details with mentioning which is the authorized signatory detail for your ITR verification. The digital signature of the key signatory details have to be associated from the individual person's income tax login and not from the companies or the trust or the ITR5 partnership firm's login. It has to be linked from the personal login, the digital signature certificate. You have to validate your bank accounts. You have to nominate in which account you would like to have your income tax refund. You have to have a proper mobile and an email ID. So here we have seen that our juniors normally put our office email or our office mobile number. Normally these mobile and email IDs are mentioned in the profile section of the assessee. So one has to if required, mention the same mobile and same email ID. You have an option for secondary email, secondary mobile, which can be mentioned as the assessing refers to you. Then you have to mention the tax regime form. You have to take care of the tax regime form, which is to be selected before filing the income tax return. You should have the DSC, digital signature, along with obviously the password for the digital signature of that DSC who is going to sign that income tax return. And before filing the income tax return, one has to file all the income tax forms which are duly applicable to that assessee. And it is suggested to accept that form also before filing this income tax return. So just a quick eye on what has happened last year. So if I have to say, then yes, for March 2023, there were about 9 crore 65 lakh people, users who have linked their Aadhaar and have filed their return. And number of returns filed is about 7 crore 78 lakhs. Yes, we all major viewing these presentations would have filed this, but just a percentage returns filed outside the office hours is about 36%. So normally 1/3 of all our returns are filed outside the office hour. So if I'm considering the office hours as 10 to 7, like the government offices, so 1/3 of our life has gone in this tax season sitting outside the office hour. So let's see if this percentage gets better in this tax season. So I think with the presentation of mine and Akshar, we all are charged up for this coming tax season, and we all should strive for reducing this percentage to less than 1 digit. And yes, the digital sent intimations is also mentioned, which is about 6 crore 42 lakh returns are already processed. So yes, as Herman Wouk has also mentioned, the only imaginative fiction being written today is income tax return. So I have tried to cover whatever is the important schedules in the income tax forms. There may be lot more when you are actually sitting to file an income tax return. You can look through, there are tutorials or YouTube lectures also on the income tax portal, which one can see and take the benefit of it. And thank you all the viewers for listening to us. And thank you BCS also for giving us this opportunity for sharing our views on the income tax return. Wish all everyone a good tax season for assessment year 24-25. Thank you so much.
Thank you, Ronak, for the wonderful presentation. Akshar and Ronak, we have few questions which are posted in the Q&A box. I have just jotted down them on a Word document. I'll just quickly, share my screen so that it's visible to all the participants as well. Yes. So, I mean, who would like to take up the first question, Ronak? Would you go ahead?
Yeah, so for FNO trading, which ITR form is applicable? So if you are having a FNO, it is the business. So accordingly, ITR 3 would be applicable for this. I think Akshar also would agree to it, as FNO trading is ITR 3.
Right.
Then on bank account reporting for foreign entities, should all bank accounts held globally during the previous year be reported? So I think Schedule F is exhaustive. So according to me, all the bank account needs to be mentioned. Akshar, you have any view on this?
No, it's amply clear. And however, other than so if you are trying to put it in your verification portion, over there you will find a problem that IFSC code it will not take, because there is no IFSC for foreign bank accounts. Therefore, FA schedule is the place where you put this information.
Correct.
So what I understand is the question really arises when you have a bank account which has been closed during the year. So as on the last of the financial year, the account is not open. Still, do we need to report? Is that, I think that would be the real question.
So yes, as in I think that will also be need to be mentioned in the tax return.
Very well. Yes. Akshar, next question for you.
So are holdings in shares listed outside India considered as unlisted shares and to be reported in the ITR? Yes, they are supposed to be. because when you go to report, there will be a bifurcation for domestic and foreign shares.
Right. Okay. So the next question is how is pension received from you? It's more from a technical point and not actually the reporting point. If either of you can take it.
So, according to me, pension received from ULIP is taxable. So here one has to see which is the scheme and whether it is uncommuted, commuted, and accordingly decide on the taxability. These days there are a lot of pension schemes which are available in the market. So one has to actually read the document carefully before making it taxable.
Correct. Right. So the next one, Akshar.
In case of disclosure of domestic bank accounts, is it necessary to mention bank accounts where your name is kept only for convenience sake? I believe yes, because the convenience is not known to the income tax department.
Right. So the question here is probably,
Where
when
if
there are
it's a
multiple
joint account,
holders.
then where if it's a joint account, then the primary account holder should mention it and the other person can skip.
Correct. Very well.
What's the AI tool called? So what I mentioned was that Institute has released it. You can look into the Institute website where it says the CA Chat GPT, and you can use our SSP login and accordingly use the AI also, as in the Chat GPT one.
Right. Akshar, next one.
The assessee has old brought forward capital gains and also F&O business loss. Will these losses be allowed in the current year and also carried forward in the new tax regime? So firstly, they cannot be set off against each other. That is very clear. And whether this can be carried forward in the next assessment year, if you have a new tax regime, then I don't see a problem as such.
Correct.
They should be.
Merely changing of tax regime does not disentitle you from carry forward of the earlier year losses.
Correct.
Great. Yeah, Ronak, the next one.
So for IFSC code to be mentioned in the income tax return in case of donation to political party. So here you have to mention the IFSC code of you would not have political bank, and it is for the UTI reference or the UPI reference number, which is mentioned in the schedule that you have to mention for the political for claiming the political party donation deduction.
Right. Okay. So the next one, Ronak, Akshar, either of you.
So 54 EC exemption from sale of depreciable office long term on account of reinvestment in infra bonds. So how to disclose is you have that disclosure under capital gain scheme. So once you have the once your block cease to exist, so you have the capital gain arising on that, and accordingly you can mention in the 54 EC. It is obviously for individuals and applicable assessees that they can claim this 54 EC. And in the ITRs, you have the deduction column of 54 EC where you can mention the same deduction. I think,
Ronak, the practical challenge here would be when the block ceases to exist, it would probably be classified under short-term capital gain. But due to a lot of judicial decisions where they have said that 50 since the asset has been long-term in nature, you can still claim 54 EC and 54F. And the challenge is really how to claim that deduction in the ITR.
correct. That is what I said. As in, here it is block cease to exit, but and then you have the short term. So here one will have to mention the same in the long term schedule to claim this 54 EC deduction properly.
Correct, correct. And maybe one can also think of, after filing the ITR, a letter may be written to the jurisdictional assessing officer, and why we can actually explain how the SSC has claimed that deduction.
Correct.
Great. Akshay, the next one.
Sure. Is schedule GST mandatorily to be filled in? So no, it is optional.
Okay.
Yeah.
So
And even if you are filling in the details, then please ensure that you fill in correct details. Otherwise, there could be mismatches because they pick details from all different sources.
Further, how are the FNO transactions reported for individuals? So as per the guidance note also for tax audit, wherein it mentions that of the institute, where it mentions that the total of the profit and the total of the losses have to be calculated together. And accordingly, one has to see whether tax audit is applicable in the same. And your FNO transaction would be helpful if you could please touch upon the loss reporting and treatment as well. So here, in case of losses, there is a view where you would require a tax audit since it's a business loss. You are showing below the limit. So here you would require to do tax audit also in case of loss from FNO. If anyone has anything to add, Akshar or Vishesh, you all can add to it.
I think that's perfect. Yes.
Uh,
Akshay,
So,
would you like
So
to
for
take the last one?
Yeah, sure. So whether an RNOR individual opts for presumptive taxation under 44 ADA, which income tax return form? So it is ITR 3, because if you read the details of ITR 4, it clearly says that it is only for a resident. Therefore, ITR 4 is the ITR which you have to file.
Correct. Great.
ITR 3.
I think, yeah. I think there were a few more questions, but most of them have already been, answered while you guys were addressing or giving your presentation. That's it from the Q&A side. Uh, Anil bhai, would you like to mention?
Yeah, just a couple of minutes. We've had, a 2-hour marathon. I am appreciative of the fact that both Raunak and Akshar have, covered whatever they could in this time. One thing that one needs to remember, especially the last comment, where 54 EC. See, this is a process where forms themselves are evolving over a period of time. So there are undoubtedly difficulties which will be there, which will remain, especially because in the year ensuing now, in the year 24-25, we will have the finance bill. What one must accept that these are situations where, as the law develops, you have a development in the forms, and in order to try and ensure that the processing becomes efficient, the department does ask for details. For example, many of my clients also say that this ISIN is a mess. But at the same time, one must recognize the fact that if your returns are going to be processed by artificial intelligence, this manner of linking, this manner of details is something which we will have to live with, at least for the next few years, till the processes become so robust that from the TIS or AIS which the department itself has, I am conscious that maybe 5 years down the line, you will have a pre-filled return based on your transactions, except maybe your business income. All your income from other sources and capital gains will virtually be tracked by the department itself. You will have this situation. Till then, there is no point in trying to be, feeling frustrated about it. I'm telling my young friends that we have to live with this for some period of time till situation evolves. You had in those good old days the situation where you filed a return of income and most of your clients waited till eternity to get a refund. That situation has changed for a majority of people. Yes, there are problems that still remain. At the same time, as long as all of you learn to live with technology, live with the fact that yes, we have to be precise and try to file the return as accurately we can, then I think most of your problems will get solved. Those which remain, uh, people like Ronak, Akshar are there for you. You also have people like Vishesh who will deal with the situation. With that, I think we'll call it a day and ask Vishesh to propose a vote of thanks in conclusion.